Brent, how much farther does it feel like this market is going to go, or do you have a sense of it?
I don't know if you can have a sense for how far it may go, because I don't think probably the market bottoms until daily new cases peak, and that's the uncertainty, right? Like, who knows what the virus is going to do? I've heard a lot of medical experts who don't have an idea, it seems like. And so I guess the three things that I would focus on are that times like these are not the time to sell stocks. There is a lot of uncertainty, but history would show you that when you panic, when others panic, your intermediate to longer term returns are subpar. The VIX hit 59 this morning. If you go back in history, there are only 30 times I believe the VIX has closed above that, and each of them have given way to positive one-year returns. And so that may not be a call on the bottom, but I do think from a longer term, intermediate to longer term perspective, stocks are becoming better values at these levels.
Sandip?
I agree completely with Brent. Clearly, you favor stocks over bonds for the long term, and the damage has been done. The repricing has taken place. This is not going to be a contained event in China. We have a global contagion, and we have a price war in oil. The range of outcomes is so uncertain that everything is up in the air. We'll have a slow, grinding recovery back higher, but at this point, you really just have to wait it out.
What if we have a recession?
If we come across one, it's likely to be one of the technical variety. It should be shallow in nature. The coronavirus was a one-time event. Pathogens do lose potency and they become less virulent. It should blow over, and then we'll be off to the races. And don't forget all the stimulus that will be put in place to fight this. We'll have a tailwind behind the market on the other side.
No, I get it. Since I'm putting a bullseye on my back, and I can't wait till 5 o'clock, but I can make an argument that the market's down 19%. You can make an argument that on a valuation basis, the market's exactly where we were 3 weeks ago, or more expensive, because nobody can tell me that earnings aren't going to be down anywhere from 20 to 25%. And the last couple of years, all we've seen is multiple expansion. So you explain that one to me, because it doesn't make a lot of sense. Quickly, J.P. Morgan, it's down more than the rest of them. Quickly, this is just my view. J.P. Morgan book value when they reported was $62 a share, traded up to $140, and people say, you know what, they deserve that price to book valuation because they're the best bank. Now I think a lot of people saying, well, you know what, J.P. Morgan is great, but now it's catching up to where the rest of the banks are. So I think the underperformance is them catching up in terms of price to book valuation.
So rational, logical. Let me actually pick up on that point, Brent, and ask you about earnings. Guys saying, look, if they fall 20 to 25% here, then all we've done is reset valuations accordingly. Would you want to make a case for earnings being taking less of a hit than that, or taking more of one?
I don't know that anybody knows for certain, and so that's the real risk that's being priced into the market right now, is there is a lot of uncertainty. I guess I would take more of a look of what's actually happening in the economy right now. It's actually on pretty decent footing. I know I heard what Joachim Fels just mentioned, and I agree that the consumer is in great shape. And I can make the argument that the market is already pricing in a recession because we have fallen by 20%, which bear markets are almost always consistent with recessions. And so I don't know how much deeper it gets than this, but certainly I don't feel like we're in for another great financial crisis like we had in 08 or 09, because the fundamentals are much different than they were then.
We began the hour, Brent, talking about whether, I don't mean to paraphrase, you can speak for yourself here, Guy, but I'll try and paraphrase that we are in the position we are in, the pickle we are in part because we've done it to ourselves with monetary policy. Do you agree with that? How much of where we are now is because the Fed has over time and repeatedly tried to protect us from the markets?
It's a great question. I don't know how you answer that. I guess I still see the Fed as a completely different organization than what they once were, and they're going to pull out all the different stops they can to keep the gap between the coronavirus before and the coronavirus after. And so if we can do that, I do think that there is some cushion to the downturn in the economy.
Sandip, I'm afraid the string just broke.
No monetary policy feels like pushing on a string. It's been overextended. Its efficacy is diminishing. But let's talk about fiscal stimulus. People worried about the size of the debt. But with the long bond doing what it is, there is an insatiable demand for the 10 and the 30-year bond, which means there are more buyers. Why don't we supply bonds? Why does the government spend? And fiscal stimulus has a bigger multiplier effect than monetary policy. So I'm optimistic. You asked the question about where could earnings end up. Here's a quick back-of-the-envelope calculation. Last year's earning 163, right now projected to be up about 7%. Probably overstated. Let's cut that down by 10%. So +7 becomes -3, 163 becomes 160. Next year, we have an optimistic or conservative 8% rise. Once this blows over, you apply a multiple of 16 to those forward earnings, which is where the market has consistently found a floor. You're right at these levels of 2,700, 2,800.
What if earnings fall 20%?
Of course, then it's a different story. But the U.S. economy, last year's GDP 2.3, composite PMI at 55, suggesting 2.5. Atlanta Fed GDP now at 3.1%, GDP unemployment at 3.5. The U.S. economy is really strong.